Welcome to FinMet Mondays, your number one podcast for all things gold.
Happy Monday and good morning to one and all, and welcome back to season two of FinMet Mondays. We are taking a brief break for the last 1 month, but we're back again. And joining me again is your favorite, Mr. Sunil Kashyap. Sunil, welcome back to the podcast once again. There's been so much happening in the markets of late, and I'd like to begin by asking you straight about what's the most important factor right now dictating gold markets, which is the Fed monetary policy. How do you think the Fed has been looking into the monetary policy? Do you think they've done a good job, and how do you think it's going to play out towards the end of the year?
Good morning and happy Monday, Sean, and it's great to be back. I think, as we had predicted with the Fed, the Fed came in quite strong as far as interest rate increases were concerned, and that obviously meant that the dollar was quite strong also, and that meant that gold was weaker, and we saw levels going down to 1,628 or so, so levels. But what's been happening subsequently is two things. One is the Fed is beginning to signal that they are seeing the impact of the rate increases on inflation, and they may slow down some of the increases in the future. Also, what's happening is other countries have been started to increase their interest rates, including the eurozone. So, relatively now, the dollar is not as strong as it was. In fact, it's pulled back against the euro, the yen, as well as the sterling. And so, because dollar is pulled back, we've seen gold rebound to above 1750 levels. So this recent increase of about $100 or so of gold is really driven by the fact that dollar was weak because the Fed seems to be coming to a level of stability in terms of rate hikes.
We've seen that on comics as well. There's been a lot of volatility of late. Any thoughts on where this volatility is coming from and what has been happening in terms of price action on CME?
Right. So partly the volatility has been driven by the fact that people are now seeing the Fed change its stance, and so the earlier um, indications that dollar will continue to be strong and therefore gold has to be weak. Those have now been revised, and so now gold is pulled back a bit. But I think also what is happening is that the most active contract, which is the December contract, is now coming close to delivery. So a lot of the longs have been rolling over their position, and so you're seeing rollovers impacting both EFP as well as price volatility, as people don't want to take physical delivery and they're actually rolling their positions up to the Feb and the March contracts. So that's creating this short-term liquidity, short-term volatility, which I think should go away about in a week's time as most of the December contracts get rolled over to the next contract.
It's also been 6 months since SEPA has been signed, and it's been interesting to see how that has played out. What do you think has been the impact, or what have been the achievements through the since the signing of the SEPA contract?
Oh, well, I think the achievement really has been that finally SEPA imports have taken place. It took 6 months or so for the respective governments to sort out the documentation required, to sort out the actual mechanics of how the export and import will take place. And what we've seen over the last couple of weeks is a more active process of imports under SEPA. In fact, FinMet did the first real import or facilitated the first real import about 15 days ago, and since that we've seen more and more customers approach us to help them understand how the SEPA imports can take place and how they can benefit from the 1% differential in interest in duty rates for SEPA imports.
Understood. Thanks, Sunil, and see you next Monday.
Thank you.